Greetings from San Jose Options. This is Morris, and I have a very interesting study for you. There's a lot of conversation around the internet about IV rank and selling premium when IV rank is higher, and the claim is that it produces better results with your option trading. And so I ran some studies on this. I thoroughly tested an out-of-the-money bull put spread on SPX for 11 years. And the study, again, I think is very eye-opening. It tells a lot about this trading method. And so let's get started here. Well, first of all, a little about our company. We're SJ Options. We're located in California, and we're specializing in trader safety, strategy design, higher order Greek education, and options software development, backtesting, and things like that. We can be found at sjoptions.com as well as sjadvisor.com for trading groups and hedge funds. So the theory is the theory of selling your options when the implied volatility rank is 50 or higher. And so the theory is when it's in the higher level, then your probability to profit increases tremendously. And so we wanted to study that, run some queries, and see if it's actually true. So we ran this 11-year back test on SPX. We started the trade in January 2005 all the way up to 2015, nearly to the end, to December. And then the exact construction of the trade was an out-of-the-money credit spread, approximately with a 90% POP, and 30 days out. Again, these are very popular strategies. People are trying to make monthly income, so very often they will sell their credit spread, again, way out of the money, and they'll start it with 30 days to expiration. So that's why we chose this study. Then we ran the same query with an IVR of 50 to 100 and then 0 to 50, so we can compare side by side both of these triggers. And it's really interesting because then we can, again, see exactly what happens under both situations. We also changed the amount of money invested, so we tried different compounding investment methods, which you'll see. We used 100%, 70, 50, 25% in order to see how that would affect the overall returns of these credit spread trading systems. So here are the results. Over 11-year back test of the SPX 30-day bull put spread, the first thing you notice is that neither one of these triggers, either low or high IV rank, produced a worthy trading system. Now remember, we're putting on the trades out of the money and we're not managing them. We're just creating a system based on probability, and then IV rank is the trigger as well as 30 days. So this is what happens when you don't manage the trades at all. Let's start on the top left. So when we invest 100% of the capital into this trading system, then both of them pretty much blow up the entire account over the 11-year span. Okay, the low IVR had just a few dollars left, so it slightly outperformed. When we drop the investment down to 70%, you see that the low IVR actually outperformed the high IVR. When we got down to the 50% investment, they were similar, but now there's a reversal where the high IVR starts to outperform the low IVR, but just barely by 2%. When we dropped it down to 25%, there was more of a significant change. However, the high IV rank trading system still lost. And then you can see when we barely invested anything, then all of a sudden the high IV rank system produced a very small profit. However, these calculations do not include commissions, and it also assumes that every trade was filled at the mid price. So once you factor in slippage and commissions, then there wouldn't be any green on the screen. Next, we created a table to compare the relative performance. And again, you see the more capital that you invest, it helps improve the relative performance of the low IV rank. And then when you lower the amount of the capital, the high IV rank used as a trigger slightly outperforms. But if you think about it, the dollar amount lost by both systems would be very similar because the high IV rank is winning when less capital is used. So let's wrap it up with our conclusion here. Number 1, the 30-day bull put spreads on SPX do not produce profits during high IV rank or low IV rank. Neither trading method actually worked in this case study. Selling put credit spreads during high IVR does not improve performance of the out-of-the-money bull put spread. Okay, so that theory that is all over the internet actually does not seem correct. The entire theory fails. It really makes no difference at all that we can see, again, because the high IVR outperformed just slightly when less capital was used, and therefore the overall amount of capital that you're losing on both systems is about the same. Number 4, the low IVR slightly outperformed the high IVR when more capital was used. And then number 5, the high IVR slightly outperformed the low IVR when less capital was used. Number 6, relying on POP alone does not work, and unmanaged put credit spreads do not produce profits. So that's very important because this is being taught all over the internet. And the fact is, at least from this study, POP calculations alone do not produce profits. And then if you do not manage those credit spreads and try to rely on probabilities, that system does not work. Some final thoughts about this trading system. Although the theory of selling premium when IV rank is 50% or higher seems like a profitable idea, in practice, it really makes no difference. Although there may be a reduction in volatility risk, the directional risk increases, which cancels out any benefits of volatility reversion potential. Okay, so that's very important, and that's a bit of an oversight and something that maybe is not being measured. When people claim you're increasing your profit potential because there's a greater chance that volatility is going to revert to the mean, well, that's true. Basically, you're increasing your volatility potential, the volatility profitability of the trade is increasing. But at the same time, volatility goes up, you're increasing your directional risk. So through the tests, it looks like what's happening is that although you're reducing your vega risk, your directional risk, your gamma risk, your delta risk, and all that is increasing, and so they just cancel each other out. And then what happens is as you change your entry based on IVR, you're just simply reducing volatility risk and increasing directional risk, and it has no advantage, at least on this particular trade, SPX out of the money bull put spread 30 days out. Okay, we could certainly run other tests, but in this one it makes no difference. Okay, so the other point here is, again, I'm not stating that volatility reversion is not a valid argument, but if you're just starting at a 50% or higher, then it makes no difference from what we see. However, if you change that threshold, maybe move it higher, let's say you only enter these trades when the volatility rank is 90% or higher. Okay, so maybe that would work. That would be a totally different test. However, if that was your threshold, then you would have very few trades. So over the 11-year span, you wouldn't be able to profit very much because there wouldn't be very many trading opportunities whatsoever. And maybe that's the way credit spreads should be traded. Maybe they should be traders should be very selective about them and only do them when the IBR is close to 100. So the final thing here is well, entering your trades based on POP and an IB rank of 50% or greater does not appear to be the answer to trading credit spreads. Well, we hope you guys enjoyed that presentation today from SJ Options. Remember to visit us at sjoptions.com. And if you're a trading group, hedge fund, or financial advisor, then visit us at sjadvisor.com. And schedule your personal demo, come to our live events, and learn more about our mentoring program. Thank you very much, and good luck with your trading.